This is RateSpy TV, your covert source for Canada's hottest mortgage deals, strategies, and market intel.
Welcome to RateSpy TV. We're here to educate, give it to you straight, get you a better rate. I'm your not-so-secret agent, Rob McClister, and today's show is made possible by our sponsor, IntelliMortgage, Canada's mortgage rate search engine. This is the inaugural episode, our maiden voyage, if you will, and we're happier than a mouse in a cheese factory that you could join us today. So let's get right to it. Here are the top stories in mortgage land this week. HSBC's 2.35% fixed rate is killing the competition. We're going to tell you if it's worth a look. BMO is giving out $1,000 cash back, but should you look this gift horse in the mouth? And as we do each week, we're going to run down the stars and dogs of the rate market. Kicking things off is the rate of the year so far. HSBC is offering a 2.35% 5-year fixed rate. And I can tell you right now, HSBC's competitors hate this rate, which must mean it's a good deal for consumers. Now, no one else is even close on refinances right now, although you can find lower rates for insured mortgages. We spoke to Paul Mullins, head of customer value management at HSBC, to see how the heck they can offer this rate. Paul tells us the rate is not a loss leader. He says there's nothing unique about how HSBC is funding this mortgage, which suggests that other banks could offer it if they wanted to, if being the key word. He says the rate will be in the market for a reasonable period of time and is not meant to be here today and gone tomorrow. Now, HSBC's goal is to engage a broader customer base, Paul says. Then they can cross-sell those customers other stuff like bank accounts, investments, and other credit products. But should you bite on this red-hot rate? Well, the answer is if you need an insured mortgage or you want a low penalty or you want to minimize your payment with a long amortization, then you probably want to go elsewhere. But if you have at least 20% equity, you won't need to break your mortgage early, and you don't need an amortization over 25 years, then this rate is, so far, the steal of 2017. Elsewhere in the banking world, BMO has a new proposition for first-time buyers. It's handing out up to $1,000 of cold, hard cash to newbies who get an insured BMO mortgage with a term of 4 or more years. Now, what's the catch? Well, it's good you asked. The answer is two things. First, the rate is higher than what you can find elsewhere. My BMO sources tell me that the bank can get well-qualified borrowers 5-year fixed rates as low as 2.69% on a discretionary basis and variables as low as 2.45%. So BMO's rates right now are average, to put it kindly. But BMO also requires you to have or open a BMO checking account to get this deal. That way they can get more of your other banking business and make this a little bit more profitable. Now, the interesting thing here is that this promo is for insured mortgages only. So insured-only specials are very rare in the big bank world. BMO says it's because they want to target first-time buyers who typically have smaller down payments. But it's also worth noting that mortgages with less than 20% down are also cheaper to fund relative to conventional mortgages, thanks to recent government rule tightening. So should you bite on BMO's carrot? No. There's your answer. We're going to say take a pass. If you peruse RateSpy.com, you can find insured rates at least 1/4 point less. That's $2,900 of savings on a $250,000 mortgage, which by our math is more than BMO's $1,000 rebate. It's time now for the Spy Do Some Rate Surveillance. After 2016's year-end run-up in rates, things have simmered down. Bond yields, which lead fixed rates, are stuck in the mud. Have a look at yields over the last 24 months. Note the top there at 1.25%. That's a 2-year high, folks, and that's a big deal. Until we blow through that number, fixed rates will remain in neutral or might even fall in their own weight. Now, of course, we're waiting to see if the Trump Meister here can woo Congress into passing his economic bag of tricks. But even if he does, we're going to have to wait to see if Trump's economic crack gives Canada a buzz. It could all be a mystery until later this year. And in the meantime, implied rates in the bond market suggest a 12% probability of a rate hike by next year. Now, that's a greater probability of a rate hike than a rate cut, but given the margin of error in these things, that's almost a coin flip. By the way, if you want to track the market's opinion on whether the Bank of Canada will jack up rates, take a look at the 2-year bond. The 2-year is a handy-dandy indicator of what the smart money, bond traders, think Polos and co. will do next. Now, until this rate gets near 1%, you can safely ignore any rate hike chatter. It's time now for the SPY Stars and Dogs segment. This is where we scope out which mortgage terms are the best buys and the most unwise. In November and December, we saw mortgage rate discounts shrink like a sweater in a hot dryer. But now, variable rates are on the comeback trail. At the moment, well-qualified borrowers putting down less than 20% can get a variable as low as 1.67%. That's prime minus 1.03. That is the best variable rate in over 3 years. Now, rates would have to rise roughly 1 point for you to be better off in a 5-year fixed. But if risk isn't your cup of tea, well, HSBC still has its 5-year fixed at 2.35%, and a handful of brokers are advertising as low as 2.28% for insured 5-year fixed mortgages. So by the way, quick tip, you can also qualify for these insured rates if you have a mortgage that's already insured and all you're doing is switching lenders. As for the dog of the week, apart from any terms over 5 years, which are perma-dogs, you'll want to steer clear of the 1-year fixed and the 4-year fixed. The rates on these terms have simply gone up too much relative to 2, 3, and 5-year terms. Now, as a reminder, the right term for you is a function of your personal situation. So keep the flexibility of short terms in mind and keep the payment security of long terms in mind when you're choosing what's right for you. So that just about wraps it up, folks, for this week. We are ultra thankful that you tuned in. And I, the SPY, look forward to seeing you back here next week. And remember, don't settle for a good rate when you can get a great rate. Every basis point counts, so the SPY is going to keep watching out for you.
RateSpy TV is sponsored by IntelliMortgage,
Canada's mortgage rate search engine.